Ever thought you could retire comfortably on just 8% withdrawals from your savings each year? Let's dive deep into Dave Ramsey's approach and see if it's really possible. In this video, we're going to explore 3 burning questions you might have about this strategy. 1. Why does Dave Ramsey recommend an 8% withdrawal rate? 2. How does this compare to the traditional 4% rule? 3. Can this strategy work for you in today's economic climate? Today, we're tackling a topic that stirs up a lot of debate in financial circles: Dave Ramsey's 8% withdrawal rate. Whether you're nearing retirement or just planning ahead, understanding this concept could make a huge difference in how you manage your retirement savings. Section 1. Background on Dave Ramsey's financial advice. Dave Ramsey is a prominent figure in personal finance, widely recognized for his straightforward and effective financial advice. Known for his best-selling books and the popular radio show The Dave Ramsey Show, his teachings focus on achieving financial peace through eliminating debt, saving aggressively, and investing wisely. Ramsey's own financial recovery from significant debt to financial freedom has inspired his approach, which emphasizes living below one's means and avoiding consumer debt. His strategies, such as the debt snowball method for paying off debts and the advocacy for robust emergency funds, have guided countless individuals toward financial stability. In the realm of retirement planning, Ramsey's advice sometimes challenges conventional norms, notably his recommendation of an 8% withdrawal rate from retirement savings, which he argues is achievable with disciplined investment and planning. This foundational understanding of Ramsey's methods sets the stage for exploring his distinctive 8% withdrawal strategy in detail. Section 2. The 8% withdrawal strategy. Explained, Dave Ramsey's 8% withdrawal rate is a distinctive recommendation that challenges the more conventional 4% rule, which has been a staple in retirement planning advice. Ramsey suggests that retirees can safely withdraw 8% of their retirement savings each year without the fear of outliving their money. This rate is predicated on several key assumptions about market performance, personal savings rates, and lifestyle adjustments during retirement. Firstly, Ramsey's model assumes robust market returns. Historically, the stock market has averaged an annual return of around 7% to 10% after accounting for inflation. Ramsey suggests that a well-diversified portfolio focused on growth stock mutual funds can achieve or exceed this range, thus supporting higher withdrawals. It's crucial to note that Ramsey advises against overly conservative investments like bonds for younger retirees, promoting stock funds that presumably offer greater growth potential over the long term. Secondly, the success of an 8% withdrawal rate heavily relies on the individual having no debt, including a fully paid-off home, and a substantial emergency fund that can cover unexpected expenses without needing to dip into the investment portfolio. This financial cushion allows the retiree to withstand market fluctuations without altering their withdrawal strategy. Moreover, Ramsey emphasized the importance of continuing to budget and manage expenses carefully in retirement. By maintaining a lifestyle that aligns with their available funds, retirees can make an 8% withdrawal workable. This involves regular monitoring of expenses and investments, adjusting as needed to prevent overspending in years when market returns are lower. Critics of the 8% rule caution about the potential risks, especially during downturns in the market. They argue that withdrawing 8% could deplete retirement savings quickly if the invested funds do not perform as expected or if the retiree faces significant unforeseen expenses. To mitigate these risks, Ramsey's approach requires disciplined financial management and a proactive stance in adjusting spending and investments. In essence, while the 8% withdrawal rate may seem appealing, it necessitates a high level of financial stability and discipline. For those who have diligently followed Ramsey's steps to financial freedom, this strategy might be feasible, but it's essential to consider personal circumstances and possibly seek professional advice to tailor this approach to individual retirement needs. Section 3. Comparisons and criticisms. Dave Ramsey's 8% withdrawal rate has stirred considerable discussion within the financial community, contrasting sharply with the traditionally endorsed 4% rule. The 4% rule, based on the studies by financial advisor William Bengen and the subsequent Trinity study, suggests that withdrawing 4% of one's retirement savings annually, adjusted for inflation, provides a high likelihood of the portfolio lasting for at least 30 years. Comparison with the 4% rule. The primary difference between Ramsey's 8% guideline and the 4% rule is the level of caution and the expected rate of return. Bengen's rule was established during a period of lower market volatility and included a mix of stocks and bonds, aiming to protect retirees against the risk of running out of funds by being conservative. In contrast, Ramsey's method assumes a higher return, predominantly from stocks, and does not account for adjusting withdrawals based on inflation. His approach is suited for those with a higher risk tolerance and an exceptional degree of financial security. Criticisms from financial experts. Many financial experts caution against Ramsey's higher withdrawal rate, especially given the potential for increased market volatility and longer life expectancies today. Critics argue that while the average market return might historically align with Ramsey's assumptions, average is not guaranteed. Periods of low returns early in retirement can significantly diminish the principal, a risk exacerbated by higher withdrawals. Financial planners often suggest more conservative strategies to account for unknown variables such as health emergencies, inflation, and changes in the economy. They also point out that the 4% rule includes a buffer that allows adjustments based on actual returns and inflation, potentially providing a safer framework for financial planning. Practical considerations. For retirees following Ramsey's 8% rule, it is crucial to maintain a flexible approach to withdrawal rates. This might include setting annual withdrawal limits based on the current value of the investment portfolio and reducing expenditures when the market underperforms. Such strategies require diligent monitoring and a willingness to adjust one's lifestyle in response to market conditions, which may be challenging for some retirees. While Dave Ramsey's 8% withdrawal rate might work under optimal conditions with high market returns and disciplined spending, it poses significant risks that must be carefully managed. Retirees considering this approach should be prepared for a dynamic management of their resources, possibly consulting with financial advisors to tailor a strategy that best fits their personal financial situation and risk tolerance. Section 4. Practical application. Implementing Dave Ramsey's 8% withdrawal rate in your retirement planning is an appealing concept for those looking for a higher standard of living during their golden years. However, applying this strategy effectively requires careful consideration of your financial situation and the broader economic landscape. Assessing personal financial health. The first step in considering the 8% rule is a thorough assessment of your financial health. This includes a detailed review of your total retirement savings, debt levels, and other financial obligations. For Ramsey's strategy to be feasible, individuals should ideally be completely debt-free, including having no mortgage payments. Additionally, having a substantial emergency fund that can cover at least 6 months to a year of expenses is crucial. This fund will serve as a buffer against having to withdraw from investment accounts during market downturns. Investment portfolio structure. The composition of your investment portfolio is another critical factor. Ramsey recommends investing heavily in growth stock mutual funds, which historically have offered higher returns compared to bonds or fixed income investments. However, this approach carries higher risk, particularly if the market experiences prolonged periods of volatility. Diversifying your investments and having a portion in more conservative assets can provide stability and reduce the risk of significant losses. Regular financial reviews and adjustments. To successfully implement an 8% withdrawal rate, regular reviews of your financial status and the performance of your investments are essential. This means conducting at least annual reviews to adjust the withdrawal rate if necessary based on the current market conditions and your financial performance over the year. Scenario planning. Engaging in scenario planning can help you prepare for different financial outcomes. For example, modeling your financial future under various market conditions can provide insights into how your funds will hold up if the returns are not as high as anticipated or if you encounter unexpected major expenses. Seeking professional advice. Given the complexities and risks associated with a higher withdrawal rate, consulting with a financial advisor is advisable. A professional can offer personalized advice tailored to your financial situation, help set up the right investment mix, and plan for contingencies. They can also assist in adjusting your retirement strategy as you age and your financial needs evolve. While the 8% withdrawal rate proposed by Dave Ramsey might be suitable for some, it requires a disciplined approach to financial management, a strong investment strategy, and the flexibility to adapt to changing economic conditions. Before proceeding, it is crucial to evaluate if this aggressive withdrawal strategy aligns with your financial goals and risk tolerance. And as we wrap up, remember that financial advice must be tailored to individual circumstances. Before making any significant decisions, consider consulting with a financial advisor. Liked what you learned today? Hit that subscribe button for more insights and strategies to secure your financial future. Don't forget to like and comment below with your thoughts or questions about retirement planning.